I made over $9,400 in the last 30 days trading less than 90 minutes a day, 4 days a week. In this video, I'm going to teach you everything you need to know about trading, from the basics all the way to the exact strategy that I used to take a small account and begin to start making thousands a month in income. No one on YouTube goes this in depth into their actual trading strategy. A lot of other videos will give you the basics and an insight into their strategy, but they will all make you pay for the actual strategy that they use. And in this video, I'm going to walk you through my whole checklist and how I trade every single day for free. But before we get into that, let's start you off with the basics from ground zero, so you can go from knowing nothing about the markets to executing my strategy by the end of this video. So before we get into the nuts and bolts of reading charts and trading, I want to set your expectations right about trading. There's a lot of people out there that want you to believe that you can make money trading really quickly, and maybe by next week that you can make consistent money trading. And in reality, this is not true. What they're trying to do is they're trying to sell you something. Most of the time, it takes people a couple years to become consistent at trading and start to make really good money from it. Now, I can't give you a definitive timeline because this is really dependent on every person. But what I can tell you what that looks like is you're gonna start out trading and just be not making any money or losing for a long time, because the power of trading doesn't actually come from taking a lot of trades or making really profitable trades. What it comes from is trading size. And so when you first start out trading, you're gonna just be flatlining for a long time. You're not gonna be making that much money. And you're gonna be, risking a small amount of money when you first start out. But over time, as you get better and better, your trading size is going to increase, and you're gonna start to see profits come in, and you're gonna slowly start to make money. And then a couple years down the road, you're gonna continue to increase your risk that you're taking per trade, and the profit graph is just gonna get exponential over time. And that's where the power of trading comes into play. Is it's not about how much you're making right now. It's not about how much you're making in, maybe a year or two. It's about how much you're making in, 5 years, 10 years, when this exponential graph essentially has had time to play out, where you're all of a sudden risking, $1,000 on one trade and making a ton of money consistently. You have to think of this in the long-term outlook. Think of it like someone who works towards becoming a doctor. In terms of financially, doctors make a ton of money in the long run. But in the beginning, they make no money. They have to spend a ton of money on school, and it takes them almost a decade to even get there. And so think of it like that. You have to put in the time and work, and it's gonna pay off in the long run. Nothing that makes a really good income happens overnight. That's called gambling, but that's not what we're trying to do here. We wanna set you up with a system that you can use to consistently make money over the long run and grow it to where you can be making a lot of money over the long run. So how much do you actually need to start trading? And so with the strategy we're gonna talk about today, I started an account to go through this process again at $5,000. And you can actually probably start with $500 in your account and then, slowly grow it over time. And so I went through that process with this account where, it's not really making that much money. The size is really small for a while. And now I've started to get to here where I'm sizing up with it a lot, and that's where I had that $10,000 month basically, where the money is starting to become actually substantial. And over this next year, hopefully I continue on this graph essentially, and that account, it could be a whole nother level in another year. And so that's where the power is thinking about building and then with the future in mind. But one thing to remember is I have been trading for about 7 years, and so this account was started after I already had a decent understanding of trading. And so when you first start out, you're probably going to be losing money for a while. And so because of that, keep things small, practice on a demo account. We'll get to that in a bit, but always be understanding that, when you're doing anything new, you're gonna probably make mistakes, and in trading, mistakes lose you money. And so the number one thing that you wanna focus on when you are trading and starting out right now is becoming consistent. Consistency is everything when it comes to becoming a profitable trader. And the biggest pitfall that people fall into is not sticking to one strategy. And they fall into something that I like to call the learning loop. And so how that works is you find a strategy you like and you start trading it. And so, everything seems awesome. You have these new patterns that seem that they'll work really well. And then for some reason over time, it's just not working out. It just logically makes sense to, go find more patterns and more strategies that seem to work and make sense and that will increase your win rate. And the thing about trading is that in the markets is that there is infinite possibilities and strategies that can happen because there are so many different markets and stocks and coins and anything that you can trade. And then there's also insane amount of different time frames that you can trade. And so what this does is it allows you to have pretty much any kind of strategy you want. And so that's why there's so many different strategies and patterns out there that people use, is because there's just a possibility for a ton of different things that work. And so what that does is you probably went from something that does have a chance to work and you switch now to something that is new and might work as well. But what you're doing is you're starting over from square one again, and you get stuck in this loop that is going to just keep repeating itself because it makes sense and you can't figure out why that things aren't working. And we'll get to this a little bit later, but the key to that is trading psychology is a really big part of the game as well. Just learning how to read charts is kind of only just the stepping stone and the start of your trading journey. And so the biggest key to that initially is start with one strategy and stick to it. Don't switch around. Now you can find a couple initially and kind of see what works for you because you do want to see what works for you and what kind of makes sense for you, but then you have to stick to it. Now the first thing you need to learn when it comes to trading is just how to read a chart. And so in terms of looking at charts, how you read them is you look at the candlesticks. And so candlesticks are just these green and red boxes that you see all over the chart. And so these essentially give you information of what the chart is doing. They tell you that the market, generally green by default means that the price is going up, and red means that the price is going down. Candlesticks can be based on a lot of different information, but most of the time a candlestick is based on time. And so one of these candlesticks could either mean a whole day worth of data in that market you're looking at, or it could be 30 seconds of data. And also they can be other things. They can be based on volume in the market and a number of other things that we don't need to go into just yet. But the key to realize with these is that generally, if you can read a chart like this, that is based on, each candlestick meaning 1 minute, you can also read a chart where each candlestick means 1 hour. They are interchangeable. The way the stock market moves, it moves the same across all these different time frames. All these patterns and things that we're going to go over mean the same thing on any different time frame. And so that's where the power of being able to read these charts comes into play, is because you can use anything that I'm talking about here on any market or time frame, because the charts are a reflection of supply and demand, the price movement, the emotions and psychology of what's going on in the market. And those are all the same across any market or any time frame. Now, to start from the more basics, each of these candlesticks, just to tell you kind of what they're showing you, again, green means the price kind of started down here and it went up over the time of that candlestick. And then red means the price went down over the time of that candlestick. To get more into the nitty gritty of candlesticks, is for the green ones, they give you 4 pieces of data. And so for this bullish candlestick, in trading, bullish means just the price goes up. And so for this bullish candlestick, the price opened at the bottom of this green box and then closed at the top of the green box. And then you have what is called wicks up here, or these little tails. These signify the extreme low and the extreme high of this candlestick. And so let's just say this candlestick means a day worth of activity in the market. And so what it would show is that the market opened up here, maybe sold off a little bit to the extreme low we have down here, and then moved up throughout the day. We don't know really what it looks like. It could be all crazy like this, but throughout the day, it went all the way up here to the extreme high we had, and then all the way down to the close right here. And so that's where kind of the candlestick is made. It's made from the open and the close, and then the wicks are made from the extremes in the day. And so it gives you an insight into what's going on. But again, it doesn't show you everything that's going on. So that's where looking at different time frames at the same time can help, but we'll get into that a little bit later. And so on the flip side, you have a bearish candlestick, and bearish just means down in the market. You know, a bearish trend usually is going down, or a bearish candlestick like this, it just means the price is going down. And so it's just flipped. The market opened up here, you know, maybe went up a little bit to get to the high of the candlestick, and then went down to the extreme, and then closed out here at the close or the bottom of the red box. And so again, this could mean a minute. And so in over a minute, the price opened here, went up, sold off. And so overall, this candlestick is showing that the price has gone down. And so candlesticks can look any number of ways. And so looking at this candlestick, when you actually start to think about what it tells you, you can start to understand what the market is doing and what's happening in the market. And so for this candlestick right here, because we can tell that the market opened here, went all the way down to the lows here, went up to the highs a little bit, and then closed off here, what that's showing you is a big reversal. The market sold off a ton in this candlestick and then ripped higher and closed higher than it was before. And so you can begin to combine these and form a whole chart. And so just combining two right here is the market opened here, pushed up, sold off, and then closed here. And then over that second candlestick, it opened here, sold off a little bit, and then pushed up, closing at the highs right there. And so again, just looking at this as a big picture, is the market pretty much just kind of bottomed and reversed higher. And so you can just start to paint a picture of what's going on. And so before we start combining all these on a chart, we need to start to look at the overall trends in the market. How does the market move in kind of a big picture? And so what you have is, what we're looking at is a bullish trend. And so bullish trend just means the price over the trend went up. And so what you want to identify when you're looking at a trend is where the swing highs are and where the swing lows are. Essentially, where is the market moving up, topping out, and then coming back, and then reversing again and moving up again. And so that's how you kind of identify where these swing highs and lows are. And then in an uptrend, these swing highs are going to continuously get higher, and these swing lows are going to continuously get higher as well. Essentially, over time, the price is moving higher and higher. Every time the market moves up and has a pullback, it's going to have another move up that is higher and breaks the high of the previous swing high, and then it's going to have a pullback, and then that new move higher is going to again break that swing high. And so that's how a market moves in a bullish trend. And then just on the flip side is, again, it's flipped, is you want to be looking at the swing highs and the swing lows, and instead they're going to be getting lower and lower on both sides. And the third trend is a sideways trend, and that's essentially where the swing highs and the swing lows are pretty much the same. The market pretty much overall during that trend is just moving sideways. And so these are the three trends you have. You have a downwards trend, sideways trend, and then an upwards trend. And so this is just how the market moves overall. So if we quickly look at a chart here, now you can start to see the trends in the chart. And so this is where you don't really need to be reading into what the candlesticks are telling you or looking at those. It's more about looking at the swings in the market. Kind of just, often I find either zooming out or blurring your eyes can kind of help with this. And you can see that, you know, just kind of drowning out kind of the noise, you can see that, you know, the market's in an overall downtrend, and it never is super clean. Like in some of the drawings, it's always changing and all over the place. The market never really repeats itself. And so that's where over time, it's really good to just get an understanding of what's going on and being able to read into the charts. So then you can learn to spot opportunities and still understand that, okay, you know, the market's kind of going sideways here, it's in a sideways trend, or okay, it's going up here, and you know, the moves are kind of weird, but it's still going up and it's in an uptrend. And so that's kind of what we want to start just understanding right now. It's just, okay, what does an uptrend look like? What does a downtrend look like? And just being aware that it kind of never looks the same. So let's talk about how the market moves. And so you can have a clear understanding of how and why things go up and down in the market. And so let's say that we have the price of a bar of chocolate, and up here it's worth $3, and down here it's worth $2 or $1. And so when the price of the chocolate bar, let's say at the playground, gets up to $3, you are super excited to sell it. And so you are going to sell it as fast as you can at that $3. Because of this, everyone wants to sell their chocolate bar at $3. And this pushes the price of the chocolate bar down very quickly because there's a lot of competition. People start undercutting each other. There's not that many people that want to buy a chocolate bar at $3 because that's really expensive for a chocolate bar. So because of that, there's not many people that are wanting to buy. And so, your friend cuts you and says, well, I'm gonna sell it for $2, and someone buys it. You then are like, oh, I need to sell it for $2 now too. And this is what pushes the price down. And then once it gets down to, let's say, $1 of everyone undercutting each other, and things start to slow down because now it's getting down to, well, where I don't want to sell my chocolate bar anymore because I'm not going to get that much money for it. I'm only going to get $1. It was just at $3. Why would I sell it down here? And so instead, people who aren't in the chocolate market, they come in and they start to buy at $1. This is what makes essentially a move down in the market slow down, is people start coming into the market and buying, and because they like the current price. Once it gets down to here, let's say $1, where people are like, wow, I'm buying all the chocolate bars I can. This is an insanely good price. And this makes the price shoot up because, well, there's not that many people that want to sell a chocolate bar down here because they're not going to get that much money for it. And so because of that, your friend now says, well, I'll pay you $2 for that chocolate bar. And the price shoots up to $2. And so now everyone's buying it for $2 because that's what the current price that people are willing to pay for it now. And so again, that cycle continues where, okay, well, now it's going to move up to where, it doesn't have to necessarily get up to this $3. Maybe now it comes up to, $2.50 up here. And people are like, well, I want to sell my chocolate bar now because I bought it down here at $1. And, I'm going to get $2.50 for it now. And so now then the price starts moving down because of that. And so this is how markets move, is they essentially balance between these levels and based on supply and demand and people wanting to sell it for a good profit or buy it because they think it's really cheap. And this is where supply and demand levels are made in the market, or they're also known as support and resistance levels. Essentially what you're looking for is where you've seen the market bounce before, it's likely to do that again because, well, that's a pretty clear demand level down here or a supply level down here. And so when the market comes down to a level like this again, you can assume, well, maybe the market's going to bounce here again and move back up. And then when it gets close to a supply area where it's sold off multiple times before, you can expect that, well, maybe sellers are going to come in here again and push the market down. Now, this is generally how a sideways trend continues sideways, and when the market is just bouncing between a stationary supply and demand level. Now, of course, this doesn't stay like this all the time because, well, the market has trends, right? Where it moves in directions. This is what trend lines are, is they are basically supply and demand levels at an angle, because as we're looking here at a bullish trend, as this bullish trend gets higher and higher, well, buyers come in and say, well, okay, the price is getting close to where it bottomed before. I want to get in before it gets there because I don't want to miss out on this trend that the market's moving up in. And so they will buy right here and the market will bottom sooner. And that's when essentially there's more buyers than sellers over time, continuously as the price moves up. And there still is a supply level that moves up slowly as well, because as this trend moves up, let's say you bought down here, well, once it moves up here, you're going to say, hey, I've made good money. I don't need to wait for the market to pull back here again, lose some of my profits and then wait for it to do this again. Why don't I just get out here and take my profits and, go to lunch? And so that's what will push the market down in an uptrend as well. And this goes the exact same thing for a downtrend, is as you move down, you'll have those supply lines move lower. And so all these trending supply and demand zones, often they're called trend lines. And then if you can match one at the highs and the lows, that's usually called a channel. Going to an actual chart, you can see that it's kind of hard to find a trend line that matches swings perfectly every time. Now here you can see there's one that looks like kind of matches here pretty well, but again, it's Trend lines often get broken very quickly. They can be used, but they don't last forever. The market breaks these things, and how they break those is that the supply and demand levels change. The market gets to a certain price, or something changes in the market. Let's say, going back to our chocolate bar analogy, is let's say the market's coming up here, the bars of chocolate are worth a lot. It's kind of getting to our supply zone. And so, usually you would expect that the market would reverse off of this. And so let's say some kid bought and ate half the chocolate bars. Now there's only half of the chocolate bars in circulation. And so that's gonna reduce the supply in the market, and that's gonna make the current chocolate bars more valuable. And so it's gonna make the price and the value of a chocolate bar skyrocket. And it's gonna break through this supply zone that we have up here, where we would expect it to go down, and it'll then adjust and move, and so the market will then get to a new price level and adjust. And so maybe down here the demand level would now be $3, and it would be $6 at the high. And so then the market breaks through here, comes all the way up to here, where it finds a new supply or resistance level, and then it starts to bounce kind of between this level, while the market kind of stays in that same area before some crazy kid eats another chocolate bar. And so looking at the market, you can start to see some of those levels. Here's a good demand level where the market came down here, bottomed, moved up, and then came down to this level again, and then reversed off of that because the demand was really strong down there. And then on the flip side, you can see up here, hey, this looks kind of like a trend or channel where the market was clearly kind of bouncing off of this level. And this is where you can really see that the market's not going to hit an exact level every time. I see a lot of the time people will use exact lines of, they want to see the market bounce off an exact line, or with their trend lines, it doesn't hit this exact level. You can see here, it doesn't quite get there. Here it breaks through that level. And that's why I like to kind of use a zone, with the idea that in this area up here, that the market is probably going to find an over of supply, and it's going to get pushed lower, because every time it comes up to this area somewhere, it reverses. And then when it comes down to this area down here, buyers come in because they like that price down here. But again, you can see over time, the swings are getting lower and lower, and the price is getting lower and lower. And so when identifying support and resistance zones and trend lines, I like to have really simple rules to keep it simple. And so what I like to do for, let's say, drawing a support level, is I like to just look to see where the market's bouncing. It's clearly bounced in this area multiple times. And so what I usually look for is at minimum 2 bounces in an area, and for it to make a pretty clear swing off of that. And so right here, I think these 2 swings right here would hit that criteria. And so what I do is then I would just, take that box in my chart platform and just label this. This is a demand zone. This is a support zone. I want to, when the market comes down here again, I want to buy it. And so, in this case, the market sold off here. You could potentially look for a buy, and it bounced off of there and moved higher. And so the same thing with trend lines is, once you start to see something kind of break out here, like in this trend line, I just look for kind of the major swing low that started that trend. And so right here, and then from there, kind of take a drawing tool, whatever you have, and then just match the lows. And so here, you can see that it started to match the lows, and it's kind of moving here. A big thing I want to start talking about now is actually reading into the market and the moves of the market. And so because nothing is the same and everything is always different, using trend lines and support levels isn't useful all the time. What you need to do is just be able to read what the market's doing. And so the super basics of that is just looking at this trend we have right here. Is look at this move right here. There's a lot of candlesticks here that are green, showing that the market has moved higher, and it's moved higher very quickly. And so that shows a lot of strength and momentum. And then the market has a pullback here that just is showing that the market, moved down a little bit in that uptrend, made a little correction. And then here again, just looking at the swings, is the market made another move up, a pullback, and another move up, and then a pullback, and then another move up. And what these kind of show is, look at these moves compared to this move. The momentum has kind of changed. And so initially there was a really big move to start the trend, and then the trend kind of got in this methodical move right here that was really probably more of the trend. And so what I like to actually call this is, I call it actually a spike, and then the market goes into a channel. And so actually we can copy our trend line here, and you can see it just matches the highs right there pretty well. The market had that big spike and then went into its kind of methodical trend up. And so what you can take from that is you can set an expectation for what you're expecting to see continue going forwards. And then when that changes, you can expect something to change. And so what I mean by that is when the market breaks this trend line we have right here, you can expect the trend to change. And so what happens here is the trend still continues higher. And so it makes a new high, it breaks this previous swing high. And then from there, it starts to slow down. And so you can see that it kind of goes into a sideways trend for a little while. And, you know, based on the swings, the pullbacks kind of come down to the same area, and then it starts to move up again. And so just because a upwards trend like this breaks like here, and then it starts going sideways for a while, that doesn't mean that the market is going to reverse right there. It can go into a sideways channel, and essentially what that is it's just consolidating. If we go back to the supply and demand analogy, to move up, there's a lot of demand, right? There's a lot of people wanting to buy continuously over time. As this trend goes higher, people are wanting to buy. And so that slowly pushes the price higher. And then once it gets up to here, as the price starts to go sideways, is because, well, there's an even match of buyers and sellers. Now there can be, you know, little spikes where the buyers and sellers, you know, play back and forth, but over time, it's pretty much moving sideways. And then it can change again where either the demand picks up again, or now the supply picks up and people want to get rid of whatever they're buying. And so here over time, it looks like the market started to go higher where people continuously wanted it. And you can draw another trend line right here. It was pretty tight, but the market kind of just, you know, stuck in a really tight trend. And so that's where trends also have different modes essentially. You can have a really tight uptrend like this where there's, you know, not big moves like over here where we have a big move up and then a big move down. Here, it's just a slow grind higher and then it breaks. And so after that, again, the trend is probably going to shift. And from there, it starts to kind of sell off for a while. And you can see we kind of essentially go into a sideways trend where, again, the market doesn't really know what it wants to do, where it's in that equilibrium. Sellers and buyers are kind of equally matched, where it's not really changing the price of the market that much. And so reading into the velocity of the market is really important because as a trader, the velocity or the volatility of how much the market is moving up and down, how much the price is actually moving, as a trader, you make money from price moving in your direction. And so generally, you want to be on the lookout for when price is moving a lot versus when it's not moving at all. And when it's not moving at all like this, you really just want to stay out of it. And when it starts to move like this, you want to be paying attention to it because that's more favorable trading conditions. And so here as well, sometimes trend lines and channels don't really help you identify when a trend is broken, but there's other ways to do that. And so right here, you can see we have a downtrend and then it starts to go into a sideways trend. And so how you can see that over time is just looking at the candlesticks here. As you can see, these candlesticks, all of these are red candlesticks. They're continuously pushing the price lower without much of a pullback. And the price over every candlestick is moving lower. Versus when you get down to here, the price starts to go sideways over multiple candlesticks. And that's showing you a slow in momentum. It's essentially the market moving down and then it's going into a little sideways trend. And then here, the market starts to keep going lower. But again, there starts to be a pullback. And because we haven't seen a pullback here yet, this is telling you that, okay, buyers are starting to come into play here and the market is shifting and it's starting to find that equilibrium between buyers and sellers where nobody really wants to sell and nobody really wants to buy. And so the price goes sideways here for a while and until things work themselves out. And then again, well, the overall trend picks up and suppliers come in, pushing the market down again. And so in trends and in larger trends, you can have the market do that where it has kind of a big move down. It kind of sits there, consolidates for a while, and then, you know, catches its breath essentially, and then continues lower. And then, you know, gets to a point where it kind of bounces a little bit, you know, it gets oversold where people are like, yeah, I definitely want to buy it down here, but it kind of gets up into that middle ground where people are like, I don't really want to buy, I don't really want to sell. And you can see the market just kind of sits here. And so this is something you want to look out for is what are the candlesticks looking like here? All these candlesticks are just printing almost the exact same price. And sure, there's some movement here up and down a little bit, but all these candlesticks, they're essentially stacked on top of each other, versus over here, both of these are very clear move downs where the market is just moving consistently in one direction. There's not much pullbacks. And if there is, like here, it's kind of quick and there's still movement at play there. And so when it comes to actually trading strategy, I've always found that it's way easier to identify these supply and demand zones and trade reversals based off of those. And, bet that the market's going to go up when the chocolate bar is really cheap, and bet the market is going to go down when it's really expensive. And so a big thing in trading is chart patterns that essentially tell you what the market could potentially do if that pattern shows up. And so the thing is about these patterns, I like to just think of them as cheat sheets, because once you kind of understand what the market is doing and telling you, you don't need these anymore. And so all of these are pretty much repeating the same thing. And again, because the market can show up in infinite ways, it's hard to make the market fit these exactly perfectly every time. But once you kind of understand them, you can just read the market and see what's going on. Now, most of these are pretty much either a reversal pattern or a continuation pattern. And so to go over a couple, a classic one is a double top or a double bottom. And so all they're telling you is, if we look at a double bottom here, it's a pattern showing you that the trend is going to reverse. And so the market's, let's say it's moving down here, and it essentially makes two swings down here that are roughly the same price. And so what that shows you is, once it kind of starts to break up here, the idea is that it could start a trend higher now, reversing. And so that same thing goes for a double top. And so what actually you also have is called a triple top. Once you kind of start to get multiple bounces like this, I like to think that, well, it's kind of just going into a sideways trend and it's not worth trading. But essentially what this is showing is the market's just starting to, it's come up, it's going into consolidation. It's kind of lost that steam. And so what can happen there is it's in a decision phase. Is it going to continue higher, which is actually a different pattern called a bull flag, which we'll go over in a second, or is it going to top out and reverse lower, making a potentially triple top like this? And so to actually go over that, here is the bearish flag pattern, and it can show up a lot of different times and different ways than this. And so to look at the bearish flag is essentially, the idea is the market's in a downtrend and then it starts to consolidate in some way. Either it has a bit of a pullback like we have here, or it just starts to go sideways. And then the idea is that the overall trend that we had up here is going to pick up again and push the market lower. And then on the flip side, it's just the same thing. And so that's where you can see, you can have what's called a bearish pennant, a bullish rectangle, and really all, or a ascending triangle. All these things right here are telling you the exact same thing. All they're telling you is that the market has, in its trend, it's gone, let's say it's in an uptrend, it loses that momentum for a little while and then continues higher. All these are showing is just different forms of consolidation. And so that's where really understanding and reading what the market is telling you is really important. And same with over here, you have a couple other ones over here that are pretty much just the same thing, either reversal or continuation patterns. And so I would say probably the strongest pattern is actually the bearish or bullish head and shoulders pattern. And this is a reversal pattern. All it does is it just takes the swing highs and lows in the market, going back to how we just identified normal trends, is, in a downtrend, you look at just the swings of the market. And, are they getting lower and lower? That signifies a downtrend. And so the trend has to shift at some point, and sometimes it'll just immediately shift into an uptrend. And so what that looks like is, well, the swings have to start getting higher and higher. And so at some point in here, that shift happens. And that is called a head and shoulders pattern. And all it is really tracks is it tracks these three swing lows for a bullish one. And then for the flip side, it just tracks the highs. And all you're looking for is it to make essentially an extreme down here, start to bottom, and then essentially this low right here is higher than this one. And the idea is that it then breaks out from there and starts an uptrend. And so the way the head and shoulders works in most of these patterns is it's a little more complicated than the theory that we just went over. Sometimes the swings don't exactly look like that. And this line here that's called the neckline is at an angle sometimes, but the pattern is still there and it's still usable in trading. And so it's important to know what those are. And so this is actually a free guide that you can get in the description of this video. It'll go over kind of the theory of some patterns and the reality of what it's actually like using those patterns and trading those patterns. And you'll actually also get a bonus fillable framework that you can use to start building your trading strategy from after this video. So you can check that out in the description of this video. It's completely free. And the next big thing of patterns out there is candlestick patterns. Candlestick patterns are basically a smaller version of your trading patterns because they use specific candlesticks. But again, I would say it's kind of just like a cheat sheet. And once you kind of read into them and understand what they're telling you, you don't need to memorize these by all means. All of these are pretty much telling you the exact same thing. This is a cheat sheet of a ton of reversal candlestick patterns. And if we just go and look at a couple of these, if we look at just this evening doji star right here, is all this pattern is telling you is that the market was in an uptrend here and it started to consolidate. This candlestick right here is called a doji candlestick. All that means is essentially the market opened, moved a little bit and then closed at the same price. There's basically zero movement in that candlestick, and your trading platforms will often make it gray like this if the price actually didn't change at all, if it opened and closed at the exact same price. But essentially all it means is that the market consolidated during that time period. And then these next couple candlesticks right here just show that the market has flipped and it's gone into a downtrend now. Now, of course, we don't know exactly what it looks like, but again, you're just looking at the big picture here. The big picture is that the market's gone up, consolidated, and gone down. And that is a reversal pattern. That's kind of showing you that, okay, it's reversed on a smaller time frame. And what you can use with that is you can use that to trigger the larger time frames of potentially reversing as well. And so we'll kind of get into this a little bit later, but I like to essentially use them as a domino effect. If a smaller pattern like this is showing a reversal, well, if you kind of zoom out, one of these larger patterns like a head and shoulder could start to reverse. And so that's where kind of, if you see one of these patterns like right here, you can use that as a kind of a domino effect to use with these patterns. And so if we look at a couple of other patterns, this pattern right here, it's kind of the same thing. The market kind of sold off. There was good momentum. Again, thinking about that momentum in the market. These candlesticks right here, yeah, the price is going up and it's green over those candlesticks, but comparative to what was happening before, it's basically going flat. This could be like a bearish flag, one of those patterns that we saw before where the market just sold off and kind of goes into a flag pattern. That's kind of like what it's supposed to look like. But after seeing it come here and then these two candlesticks right here push the market higher, it's showing you a clear reversal. And so that's where kind of the market comes down, it loses that momentum and then moves up. And this is a really big factor of why you can't just blindly see these patterns and assume that the market is going to do that. That's not really how the market works. The market doesn't know that it's in a bearish rectangle. That's something you are recognizing. And there's so many factors going on in the market and time frames and all this other stuff going on that on your specific chart, if you see a bearish rectangle right here, or what I just called a bearish flag, that doesn't necessarily, just because you spot that does not mean that the market's just going to sell off. It could do what we just talked about, is it could be the downtrend losing momentum and then the market breaks out here. Only in hindsight, after seeing the market move down, go into consolidation and then moving lower, could you say that this is a confirmed bearish flag. And so in trading, these don't really help you execute actual trades. That's why you have to use a couple of other factors that, again, I'll show you how I do it with my strategy a little bit later. And so that's why with any of these patterns, I don't like to take them and use them as a sure thing that, oh, I saw this, it's gonna do this, because nothing in the market is like that. You don't know what the market's going to do. And so that's the whole idea of the market, is we're not gambling, but we're making an educated guess based on what we're seeing. And over time, that plays out in our favor. You're doing the exact same thing a casino does. A casino doesn't win every bet, but over time, they make money because things work out in their favor in the long run. Now let's talk about time frames. Now, when it comes to trading, it's all about finding what works for you. What is going to make you a consistent person as possible when it comes to consistently sitting down to trading? You want to be able to try and trade at the same time every day and consistently repeat your trading routine, because that'll just help you with trading in general in the long run. And so what time frame you choose will depend on a couple of factors. Now, larger time frames, let's say 1 hour or greater, where every candlestick is 1 hour, or maybe every candlestick is a day, that's generally best for trading over multiple days. Anytime you're looking at a chart and it's an hour chart, it's going to take multiple days for a trend or a pattern to play out. And so you're going to have to hold that over multiple days. And so does that work for you? Is that easier for your schedule because you can only look at the charts at a certain time of the day, or you don't want to look at the charts that often? Now, the big con I would say with trading larger time frames is you have to hold stuff over multiple days. And so you're holding trades overnight, over the weekend. And so it's on your mind that you're still in a trade and you're thinking about it. It doesn't allow you to separate from it. Versus if you trade on let's say a 1 minute chart or a 5 minute chart, those timeframes are more for day trading. They're gonna allow you to jump in a trade and then get out of it at the same day, because the patterns that you see on here are gonna play out very quickly over time. And it's just gonna be maybe 30 minutes that you're in a trade, an hour, 5 minutes. That always depends on the velocity and the movement of the market. But on average, you're gonna be in a trade a lot shorter and just, maybe a couple of hours at the most. Now, the harder part about that is it's a lot faster. The smaller the time frame, the faster the moves, and the faster you're going to be more in tune with the market. You're going to have to be more in tune with the market. And so this isn't something you have to know right away, but keeping this in mind as you're going forward. And so for me, I only trade, 90 minutes a day in the morning and 4 days a week. And so I decided to only trade 4 days a week because Mondays I kind of like a transition day from the weekend, kind of get the week started. And then the 90 minutes is just because that's how long I want to just trade. When you're day trading, a big misconception is that you need to be in front of the charts all day long. And that's not true. I actually think it's better to be in the charts a short amount of time because you can be super focused. You can make the correct trading decisions. You can get in, get your trade if there is one, and then get out. And to be honest, sitting in front of the charts all day is not how I want to spend my day. It's really boring. And again, over time, as you size up, you could be making a really big trade in the morning, and that's all the money you need. Now, a huge important part of trading is risk reward ratio. How much money are you risking and how much money are you theoretically trying to make from that? So in trading, a really big key when you're actually entering into trades is when you enter in a trade, you are risking a certain amount to make a certain amount. And so let's say for simplicity's sake, let's say we're risking $100 here. And the goal of that is to make $300. And so every time I win, I'm gonna make $300. And every time I lose, I'm gonna lose $100. And so the risk reward ratio of that is a 1 to 3 because I'm risking $100 to make $300. And that's a really favorable risk reward ratio. You can have other things like a 1-to-1 risk reward ratio where you're risking $100 to make $100, or you can have some people, which I never suggest doing, having a really bad risk reward ratio where you're risking $100 to, let's say, make $50. And so when that happens, you have to win a lot. And so really big important part of this is your win rate and what your win rate has to be to break even or start to make money. And so looking at that is if your risk to reward ratio is 1-to-1, where you're risking $100 to make $100 and your win rate is 50%, you are break even. You are not making any money over time. You're also not losing money over time. And if your win rate goes higher, you're going to start to make money. And if your win rate goes lower, you're losing money. And so as you go higher on the risk reward ratio or more favorable, let's say to our 1-to-3 risk reward ratio, and with that, you only need to win 30% of the time to start making money. And anything higher, you're consistently making really good money. And so that's where if you go worse than 1-to-1, like we had, where you're, let's say risking $100 to make $50, your win rate has to get insanely high for you to consistently make money trading or even just break even. And what that does is that puts a lot of pressure on every trade to work out. Versus if you're at something like a 1-to-3 risk reward ratio, you can lose 3 trades in a row and have one trade take all that back and put you at break even. And then let's say you win another trade and now you're up a ton of money. And so that's a big thing when trading is there's a lot of pressure on each trade to work out. And this takes that kind of pressure off of that. And that's where the mental side of trading really starts to come into play. And this will set you up for success in that regard, with going, I would suggest sticking in the realm of 1 to 2 or 1 to 3. Anything lower than 1 to 2, it starts to become not as favorable. And then anything higher, you're looking for home runs and you're just getting excited about the money. And again, the sweet spot is kind of that 1 to 2, 1 to 3 risk reward ratio. And so that's a big thing where that learning loop comes into play. And the mental side of trading, you can give an insanely profitable strategy to a ton of different people, and none of them could be profitable at it because they don't understand that it's going to take a while to go through that growth process where they're losing, but they're learning and making changes in their trading that actually work out. And so a big thing that you need to do is you need to journal your trades. You want to start tracking your trades, and there's a ton of really good software out there. I'll link the trading journal that I use below this video. And what you want to do is you want to track your trades, and you want to also track the emotions that you felt in those trades, why you got in, what you were feeling when you got in that trade. A lot of the times when you're trading is you'll have a lot of emotions that will come up in your trading. And that's super important to start to keep track of, because then again, this is building your foundation that we're focusing on. And over time, it'll help you grow into the trader that you want to be in the long term. Now let's talk about what assets you can actually trade when you're trading. And so you can really choose any that you want. That's the awesome part of reading charts, is that they can be interchanged into any market or any time frame. You can take a strategy that reads a stock chart and use it on a different chart and market entirely. And so the first thing is trading stocks. You can totally trade stocks. They are super simple. You buy it, it goes up, and you make money. And you can actually sell it and bet that the market is going to go down as well. All that is called shorting. Shorting is just meaning you're just doing the flip side. You're betting the market's going to go down and you make money when it goes down versus your normal buying. And so that's where buying and selling comes into play. So you can buy and sell stuff, make money either direction. And so that's the power of actually trading, is you can do that. And with stocks, the leverage though is really low. Generally, if you have $10,000 in an account, you get only $10,000 in that account to trade with. Now, what you can do is something called, you can make a margin account. And so all that means is if something, let's say something requires $1,000 worth of margin, well, my account will be reduced that $1,000. But when I close whatever that position was, let's say I bought shares and it costed 1,000 margin. Well, when I sell those shares, I will get that $1,000 worth of margin back. But this isn't taking into account the money you either made or lost from that trade that you took. The simplistic way of thinking about it is like collateral. It's money that you have that is just required to get control over an asset, and then you get it back after you've closed that position that you traded. And so for stocks, what you can do is you can get a margin account that generally just doubles your account. And so pretty much it allows you to, instead of having $10,000 worth of buying power, and buying power just means how much you can essentially buy. And so let's say I want to buy shares of Apple, and let's say Apple is at $100 a share. If I want to buy 10 shares of Apple, that's going to cost me $1,000. And so that then leaves my account at $9,000. And so I'll have $9,000 worth of buying power, but I'll also have this $1,000 worth of Apple in my account. And so that's where buying power comes into play, because what you can do is you can get a margin account, which will then take this $10,000 account and it will essentially make it a $20,000 account, because it'll give you $20,000 of buying power versus the 10 that you had before. And so you'll be just putting up margin for trades and getting that collateral. Now, a big thing about this to understand is that this is where leverage comes into play. This is essentially how leverage works in the market, is you are taking your $10,000 and you're actually able to control $20,000 worth of, let's say if you bought $20,000 worth of Apple shares, you then have $20,000 worth of Apple, but you only really had to put up $10,000 to buy it. And surprisingly enough, this is a low amount of margin compared to what is out there. And the major con about stocks is if you are wanting to day trade, which in very specific terms is you want to buy and sell in a specific day, you have to have $25,000 or higher in your account. And so if you're someone that wants to start with a small amount in their account, this just isn't feasible. And what's stopping you from doing that is essentially something called the pattern day trading rule. You can look it up and read into it more, but the main thing is that you can't day trade consistently in an account without more than $25,000 in that account. And again, this is specifically for buying shares on stocks. Now, the next one is options. Now, what these are is they are extremely difficult and complicated. I definitely would not suggest trading these. I actually used to trade them myself and I stopped trading them because they just overly complicated things. And the only good thing about them is they probably give you the most flexibility and leverage that there is. But in my experience, after trading them for a long time and now switching to other assets that we're going to talk about, it's not necessary. In trading, there's already so much going on that keeping things as simple as possible is the best way to actually be consistently profitable at trading. And that's what I found out through a lot of pain and effort of trying to figure this out. So options do give you probably the highest leverage there is, but again, I think they are overly complicated, and a lot of people lose a lot of money trying to figure them out when they start out. So I would, again, word of caution, try and stay away from them until maybe years down the road, and you can start to try and dabble in them if you really want. But again, I don't even use them. I don't think I'll ever use them again because they're just not necessary. Now, the one that I actually trade is futures. Now, futures are like options. They're essentially a derivative. They're based on a certain market. But when it comes down to the practicality of actually trading them, futures are, I think, very, very simple. I think they're very similar to buying and selling stocks and shares. Really, all that you do is you buy it and it makes money if you go up, and if you sell it and short the market and bet it's going to go down, you make money if it goes down. With options, I didn't really get into it, but there's all these other things that are very complicated, where if you are trading options and let's say you buy it and the market goes up, it's a possibility you actually lose money. And so without getting into the nuts and bolts of it, options are really complicated. But with futures, you still get that really high leverage. The leverage might not be as high as options. I don't really know off the top of my head, but in my mind, the leverage is plenty. You can get way more leverage than you really need, and you can use it to grow an account. And so I'm a little biased, but I think futures are the best thing to trade because they allow you to kind of get the best of both worlds. Now, the other two that are kind of similar are trading Forex or crypto markets. Now, these are about the same in terms of they're kind of medium difficulty. Generally with them, they're simple as well. Like if you buy it and it goes up, you make money. And if you sell and bet it's going to go down and it goes down, you make money. And the leverage on both of these is pretty high as well. You can definitely get as much leverage as you would ever want. In the Forex market it technically means foreign exchange. And all it is it's the markets and charts that track the difference in value between, let's say, the US dollar and the euro. And so, it just tracks the difference in those values. And so that's what you're trading essentially. But again, at the end of the day, it's literally just a chart that you're looking for patterns and you're buying and selling. Now, the only negative I would say about these two markets is there's a lot of shady kind of stuff going on them. Now, of course, the market has kind of that stuff across the board, but I would say crypto especially and Forex is that there's a lot of brokerages out there and places that you can trade on that are not regulated, and they're across seas from the US. And so they're out there to scam you. They're not there to make a good trading platform for you to trade off of. And so I would really be cautious if you do want to go down that route. Make sure you trade at a really big exchange. And even some of the big exchanges like crypto have, had issues. And so again, word of caution there. And even with any of the assets you want to trade, always go with one of the major ones. Don't go with the small ones that for some reason are, maybe they have some really big promotion or are very enticing to get onto. The reason why they have that is because they're somehow taking advantage of you in some way. Stay to the bigger named ones. Just Google the top 10 or whatever and stick to some of those, because the platform and brokerage scene is so competitive that they're all relatively the same price in competition in terms of fees and commissions and how much you have to pay them to trade. And so again, where you can go awry is getting on a platform that isn't really there to do good by you. They're really there just to make money from you. And so in terms of platforms and brokerages you can try, my first suggestion would actually be TradingView. TradingView is a really good platform that you can chart on, you can practice, you can actually set up and actually trade on as well. And it's accessible from anywhere in the world. So you don't have to worry about if it's accessible for you in your country. There's a ton of different brokerages that you can connect to it. And so that's, I would say, the best overall platform that you can use. Now, the one I use is actually called NinjaTrader. It's a platform that's more geared at trading futures specifically. It's one of the biggest ones out there. And so if you're interested in trading futures, I would definitely check it out. But you can also use TradingView. So that's a great spot to start for either of those. And so either of these platforms works really well for trading. And I will link both of those down below this video. Now, a big thing with either of these platforms, wherever you make an account, is start demo trading. And so what demo trading is you're just trading with fake money. When you start trading, you don't need to start out risking your real money, because again, think of it as the long term. When you first start out, you are going to be losing money consistently. And so why lose real money right away when you're going to start out losing money? When you can start out trading with fake money, lose real money, continuously, get your learning onto you, learn. And then when you start to get a grasp of things and you kind of start making consistent profits in that demo account, you can then switch to real money and then start continuing that journey there. Essentially, it allows you to skip a lot of this potential heartache and money loss that you could lose that could just knock you out of the game and make you give up on trading before you've even given it a chance. Again, think of the long term of trading. That's the biggest important part. Now let's talk about trading order types. These are going to be really important when you're actually trading and entering in orders. And the first one is called a market order. Basically, all this means is when you put in the order, you are telling the system that you want to buy or sell at the current price. And so what that really means is, if we look at a chart, is, well, if I click buy market, which means I'm going to put in a market order to buy, it's going to instantly fill me. And so I'm going to instantly put in an order and I'm going to get long and be, making money if the market goes up. Now, the thing with a market order is, let's say you click buy market at a current price right here, but the market moves so quickly is it can actually move and you can buy it at a different price. And so a market order isn't going to necessarily fill you at a specific price. The idea of it is it gets you in or out of the market as fast as possible. And so if I click sell market up here again, it's just going to close out at whatever price that the market has at that time. And so you can get what's called slippage, where, I put in the market order, let's say at this price, and the market moves so fast, let's say in the blink of an eye, it goes all the way down here with a big red candlestick. Well, my order actually got filled here. And so that's what can happen with a market order. Now, that doesn't happen very often, but it can. And so that's a big thing to be aware of with a market order. The next thing is a limit order. A limit order is you're trying to buy or sell at a specific price. So I can just say, I want to put in a limit order at, let's say, 100. And if the market's trading at 101, it's not going to fill that order. It's going to have to wait until the market comes down to 100 to fill that order. And so right here, if I put an order for a limit order at this current price, well, the market will only fill that order if the price comes down here. And so the price looks like it might come down here, it might not. And so the thing about a limit order is it'll fill you at an exact price, but it might not get filled. And so if I am trying to buy down here and the market, like it does right here, shoots up, well, and never comes back to hit my order, I've missed out on catching that potential move. And so that is the kind of the downside of a limit order. And so these are the two main orders that everything else is built on. The next order, which is called a stop order, is a type of market order. What this does is it only becomes active when the market reaches a current price. The idea of that is, let's say I want to bet the market's going to go up right here, but I only want to get in if the market breaks above this price. And I want to get in with a market order, because if the market, comes down here, breaks above this price, I don't want to miss out on the potential move. And so what I can do is I can come here, I can say I want to put a buy stop market in, and this will wait until the market comes up here, hits that order, specifically that exact price, and then we'll put in a market order. And so what that means is it'll wait until it gets there, but it might not fill you at that exact price, because again, it's a market order. If the market goes through this really quickly, the order could trigger right here. You could actually end up buying right here. And so that's where that kind of idea of slippage comes into play. Again, that doesn't happen very often, and it doesn't happen at a large scale. Generally, a lot of the time, if it ever happens to me, it's just a tiny amount. But that's the whole idea of a stop market order, is you're making sure you're wanting to capture the breakout and you're not wanting to miss that move. The other version of that is a stop limit order. And this is just a limit and a stop order put together, is where you essentially, if we go back to the chart again, I say that, okay, I want to put in a buy stop limit order. That means that if the price comes up here, it's going to put in a limit order at that exact price. And so if the market comes up here and breaks through really quickly, I might not get filled on that order because I put in the order to get filled at this exact price. And you know, based on that supply and demand talk we had earlier, well, maybe no one wants to sell me what I'm trying to buy at that price anymore. And so the market could be all the way up here and my order could be down here waiting to still get filled. And so the problem with that is that you can miss out on a potential trade. But if the market's going crazy, you also don't have that chance for the market slipping on you and you getting filled at a price that you don't want. So if the market's moving more methodical and it kind of breaks up here and kind of moves like this, well, you can have that limit order. It gets input once the market hits that level, and you can get filled at that price that you want. And so those are the key orders that are in the market. So a big thing when it comes to trading is called bracket orders. And so the most important one of those is called an OCO order, or a one cancels other. And so what an OCO order does is when you input your order, let's say I want to buy at this current price the market gets to. When that order is filled, it'll input you a order that will take your trade for, let's say, your $300 that you're trying to make, or it'll put in an order that'll get you out of your trade for your $100 that you want as your max risk. And so this is usually called a take profit, and then this is usually called your stop. So the whole idea of the stop loss is this is where I am saying, okay, I'm wrong. I need to move on to the next trade outcome. Because when it comes to trading, a massive thing that you can do that will ruin you is letting it just go against you indefinitely, hoping that it's going to reverse in your favor and you'll eventually make money. You never know what the market's going to do. That is essentially gambling. What we're trying to do here is have a methodical framework built way to make consistent money from the markets. And that's where that risk reward comes into play, that math side of trading. Trading, people think it's very complicated math-wise. The only math is that risk reward of where I'm trying to risk $100 to make $300 consistently. And you have to stick to that so you can let the math play out over time. You cannot have it to where you are trying to make $300 every time and then you all of a sudden lose $1,000 on a trade because you didn't want that one trade to lose. You couldn't accept the loss. You're going to lose in trading. That's just a part of it. And so what we can do here is I will put in a sell stop order that as the market breaks lower, I'm going to bet that the market's going to go down. I'm going to short the market. And so you can see here, it filled that. And so as soon as it hit that, it input it in a market order and we got filled. And now we're going to trade betting that the market's going to go down. And so on my platform, NinjaTrader, it has these really nice things on the chart where you can see your orders on the chart. You can see how much money you're up and down, and you can change them. And so here, this is where that OCO order came into play, where it put in our profit target down here. We'll make money and close out for a profit if the market gets all the way down here, and we'll close out for a loss if the market comes up here. And that's our trailing stop order. And the way the OCO order works is if the market hits one of these, the other one will close. And so the idea is that it's waiting for one of those two outcomes to happen for us to either make money or lose money, however we've set it up. And a big reason why you want your trailing stop to be a stop market order versus a stop limit order is because if you're in a trade and the market is going against you and you're losing money like we are right here, if this is a stop limit order and the market just, all of a sudden, let's say some crazy move happens, it just bursts up here. Well, a stop limit order, like we talked about earlier, it might get input into the market, but it might not get filled. And you were planning to get out at this level, but because you had it as a limit order, and a limit order will only fill at a certain price, and that won't always get filled, well, the market could be now up here, and you could still be in that trade losing way more money than you intended. And so that's why with your order to close out a trade, you always want it to be a stop market order, because you want to get out as soon as possible and as soon as it goes against you, because if you don't, you're leaving yourself open for times where the market could have a crazy move in one direction and you're still in the trade losing way more than you thought. You'll hear stories where people lose more than their account size, where they've lost an insane amount of money that they didn't intend, and it's generally because they did not have one of these in place. Maybe there could be some crazy glitch out there that happens, but the majority of the time it's because they didn't have one of these orders in place to begin with. They kind of let the trade go against them because they were hoping that it would come back in their favor, or they didn't have one of these in place and the market just went really far against them. And so that makes it really easy to actually trade. And so what we can do is you can move these down, and you can see there the market hit that order and then it closed out of our profit target. And so that's how kind of those OCO orders work. They cancel the other one. I use that on every trade that I take. So now before we go into an actual strategy, I want to talk to you about some of the biggest trading pitfalls and things that you can do that will derail you on this journey. And these are the most common ones that I see. And one of those is using prop firms. Now, this isn't necessarily a massive pitfall, but it's definitely a trap that beginning traders fall into, I think. Now, if you don't know, prop firms essentially prey on the idea that you will be able to pay a small subscription to get access to, let's say, $100,000 account to trade on. Now, that sounds really, really awesome and enticing, because a lot of the time those subscriptions are pretty cheap in terms of controlling that much money. But how they have it set up is you have to essentially pass all these tests, and those tests are hard to do, especially as a beginning trader. You essentially have to prove that you can consistently make money over the long term profitably. And so because of that, well, that takes people, let's say, a year or two to do. And well, if you're doing it on these prop firm accounts, you're essentially paying a high subscription to just get access to a demo or paper trading account that you can get access to for free on any of the other platforms out there. And so you're basically paying money with the idea of, a big payoff or a big chance to use a big account in the long run. And so I think to get around this, if you do really want to try it out, trade on a demo trading account first. And then when you have some experience and you can consistently actually make money on a demo account, then try one of these prop firms to make money off of. Because otherwise, again, you're just spending a lot of money for a demo trading account, which is free everywhere else. Now, the next big one is trading alert services. This is the idea that, someone will essentially sell you their trades. You can, you'll join into a chat room or something where you can get alerts of when they're buying and selling. Now, these a lot of the times are, even if you're following someone who is actually profitable doing it, it's very hard to actually profitably do it yourself, because all these alerts are delayed, and you as a user it's very hard to do. I've tried it myself in the past, and even though I was following someone who was very profitable, and I know they were profitable because they were sharing it very transparently, I still had trouble doing it myself. And at the end of the day, you're not actually learning to be a profitable, consistent trader yourself. And you don't know how long that person's going to be around and if you'll be able to follow their stuff for that long. Again, focus on the foundation and building it for yourself. Now, another thing is check the trading results of the person or the strategy you're trying to follow. So many people out there try and pretend that they have good trading results. Another big thing is you'll see lifestyle marketing. They, show their fancy car, their expensive lifestyle, and they'll say that that's from trading. And the only way to really know if someone is making money trading is if they show you their account returns, like their brokerage statement. They log into something And even photos can be photoshopped. So if you can see some kind of video of someone accessing something, that's really the only way that you can really truly verify that someone is actually profitable trading. Otherwise, there are a ton of people out there trying to scam you, say that they're profitable trading, and in reality, they are not. And so really be careful of that. Another one is trade on large platforms. We kind of went all over this, but be aware of a lot of the brokerage and trading platforms out there just trying to take your money. And so again, stick to the larger ones. Just Google maybe the top 5 of the style of trading you're wanting to do and stick to that. And another thing is just be aware of literally straight scammers. There are a ton of people in either like my YouTube comments, fake Instagram accounts, trying to scam you and pretend to be me. And so really be aware who you're sending your money, really be aware of that and make sure you are in contact or on the correct website of the person that you're trying to get information from, because there are a ton of scammers out there just trying to impersonate and take your money. And another one is never give someone your money with the idea that they are going to invest or trade for you. The only people that will do that are scammers, because that is really actually illegal to do. And I have to say it again because it's so important, is that learning loop. Find a strategy and stick to it, and then start to focus on the mental side of trading, because otherwise you're just going to be stuck in that loop. That was something I was stuck in for probably about 5 years before I got out of it and eventually started a trading strategy that I was able to consistently do. Make sure you find a strategy you like, but then stick to it and start to focus on the mental side of things and journal. Now to go into my strategy and to, practice what I preach, let me show you some of the results I had with this account. This right here is the results from the first year. I had this $5,000 account. I made 5K in that account, and this is more the profit graph from that, where it was pretty up and down. And so that's from sometimes the trading strategy, but also my ability to execute the strategy. I'm not perfect. I have, a lot of downswings. And for me, in my trading results is when I get overly stressed and I try and force trading and I don't focus on the strategy and just focus on the process of trading and, trade how you should trade. Sometimes I get overly emotional, or I chase trades or FOMO, whatever it is. So that's why a strategy can have ups and downs too. And so to show you some more recent results of, especially where, I've been talking about how it's now making me a lot more consistent money. If we just go to last month, I made a little over $9,400 in the last month of trading. And so that account has, grown. It's slowly grown. It, last year was that kind of year where I made 5K. And then this year it continuously kind of stayed on that cycle of slowly growing, some ups and downs. And then I've got to a size where I'm risking about $600 per trade. And so when I'm doing that 1 to 3 risk reward ratio, every time I lose, I lose about $600, but every time I win, it's $1,800. And so once your size gets to that point, you don't need that many trades to make a lot of money in 1 month. And so the number of trades I took last month was 7 trades. It actually says 8 on here because one of them got split just based on how the orders filled, but I only took 7 trades in 1 month. And so that really shows you the power of that sizing. Even for me, I'm a day trader. When you first start out, you think, oh, day traders, they trade tons of trades a day and they're going crazy. And in reality, that's false. You do not need to be taking a ton of trades to be consistently profitable trading. I think it actually is harder to be profitable taking a ton of trades. If you take just a couple of trades a month, the whole idea is you are focusing and looking for when your strategy perfectly sets up and you can confidently take a trade. Because for me, if I'm gonna put $650 at risk, I want to be sure that I am really confident in that spot, because you know what, this number over this next year could double or triple. I could be risking a lot more. And in the future, just talking about that equity graph of you making more and more money and risking more money becoming exponential, you got to be sure that you are entering in a spot you really want to enter. You don't want to be messing around. And so that's where keeping that focus on, okay, I'm building the foundation. I don't need to be making money right now. I just want to focus on getting in the best possible trades in that month. and having it deliver good results in terms of your risk to reward ratio and your win percentage, and then just realizing and remembering, over time you can scale it. Now, if we look at, this month comparatively, this month it's a lot slower. It's December. I've taken 4 trades so far. Again, another one split because of the orders, just to kind of show you what that looks like. You can see here are my trades for the month. There's 2 trades of the same symbol, same price, same duration. It's just, they're both wins. That's just kind of how it comes out in this system. But I took 4 trades, or I've taken 4 trades so far this month, and I'm kind of 2 weeks into the month. And so far this month hasn't done as well. December's kind of a slower month. The trades, the market has just been honestly kind of crappy. I'm only up $600 for the month so far. And that can be frustrating, but this is where trading isn't about the current month. It's about the long-term picture. It's about, how much are you making over the long term? And then again, keeping in mind, okay, over the long term, I'm going to be increasing my size. I still have a week left to trade. And so you never know what could happen. I had a trade last month that made $3,000 almost in one trade. And so, you don't need many trades. I could just take one trade that's a good winner and still be up, close to 4,000 for the month. And again, that's still a really good income on, I would say, frankly, a crappy month. And so you have to remember that the results are important, but it's not about the results right now. You have to look at the big picture. Remember that not every month is going to be good. You're going to have some months that are great, some months that are not great. Maybe for me, like last month, I had a really great month making 10K almost. And then, maybe this month's kind of a sideways month. But big picture, if, the next couple months I make a bunch of money, you're still consistently making money over time. And then you're going to start scaling up and getting, bigger and bigger. And, that this $500 or $600 that I'm up could be $2,000 later down the road when I'm a much bigger size. And so that's one thing I really want you to focus on when you're trading is it's not about how much you're making right now. It's about the potential that you're trying to set up and build a foundation for in the future. Now, let me walk you through my actual trading strategy that I have used to grow that small account from a small amount to now making a hefty amount per month potentially. And so I'm going to be using concepts that we have talked about in this video. Nothing else is really from outside of this video. All I use to trade is really looking at supply and demand levels and just reading the candlesticks and the movement of the market. That's the simplest way I have found to trade, and I think it's worked out really well. It's simplified things and made things a lot easier to become consistently profitable at. And so the main idea of what I do is I look for reversals in the market. And so going back to that supply and demand idea is whenever the market comes down to a area that I've identified as a demand zone, I look to buy and bet that the market is going to go up. And then when it ever comes up to a supply area that I have previously identified, I bet that the market is going to go down and look to make a profit off of that. And so what this allows me to do is it allows me to keep my risk small by having it, if it kind of breaks that supply zone and shows that it's going to keep going higher, I can get out at a smaller loss. And then if it holds and pushes the market back down, that's where you can get your 2 times, your 3 times your risk reward, or even sometimes I get 4 or 5 times my risk reward. And so that allows me to, again, quickly going back to the results of last month, I was able to have a trade that made $2,800, and the risk on that trade was still around my $600 mark. And so it allows you to make a lot and risk a little. So even when I have months kind of like December where I'm not hitting as well and it's just not playing out as well, I don't lose that much. It's kind of break even. So the main thing I do is I basically look for these levels, have the market come down to that level, look for a couple factors. Usually I look for a candlestick pattern, a chart pattern, and then a couple of other patterns that we're going to go into. And then that signals for me that, okay, I think the market's going to reverse here, and I bet higher. And so how I usually trade is I usually enter in my trades on a 1 minute or a 5 minute chart. But how I find my levels is usually on a 15-minute chart. And the idea behind that is the bigger time frames have bigger, stronger moves. And so if there is a demand zone made on a 15-minute time frame, I think it's more likely to be stronger and a clearer, more powerful zone than one made off of a 1 minute chart. And so the goal of that is to increase the likelihood that I have identified a key area in the market. Again, this can work on any other market or time frame. You can use higher time frames. Then the whole idea is just using a higher time frame than what you're entering in on. If you want to enter in on a 1 hour chart, you could be looking for supply and demand zones on a daily chart or maybe a 4 hour chart. Looking at the charts and time frames will kind of help you do that. And so with all the trades I show, there are always recordings and trades that I have actually taken. And so I'm gonna walk you through an actual trade that I have taken. And so this is another really big key thing that I do that I don't really know if anyone else does. Most people just show stuff in hindsight, or they'll just show something on a chart and say, oh, you should have take a trade here or take a trade here based on this pattern. And you know, that's, anyone can do that. Anyone can go into a chart, look at something and say, oh yeah, it reversed up here. Let me find, you know, a reason to why I should say that happened. And so that's another thing to kind of be aware of. That's kind of another thing scammers, I would say, like to do. And so for me, I don't do that. I will show you the trades I actually took and walk you through exactly why. And so first thing I always do is identify those support and resistance levels. And so this chart we're looking at is actually oil futures. Again, I trade futures. We don't have to dive into that too much right now. The main thing I want you to be focusing on is the patterns and how I'm reading the chart. You could be doing this on any chart or market. And so again, don't really worry about that. Just look at the candlesticks and how they're forming. Now, another thing you'll notice is my candlesticks are blue and white. Blue means it's going down and white means it's going up. And so the whole reason why I do this is because trading is emotional, and seeing red and green are good and bad emotions. And so I found that it's a little trick to help get away from that is changing my candlesticks to a different color. And so that's what I've done. I've changed them to white for up and, you know, blue for down. They're basically just calming colors. What am I looking for? And so what I'm seeing is the market's kind of bouncing here, and it's kind of, you know, maybe there's a resistance level up here and it's kind of bounced here a couple of times. And so maybe there's a support level down here. These are kind of smaller swings. And so on the day up, when I was actually looking at this, if we move to a 5-minute chart now of this, you can kind of see it's similar pattern. It's just more candlesticks, kind of let us know what's going on. You can still kind of see that the market has bounced off of here multiple times, and then it's kind of bounced off of up here multiple times as well. So for me, I start trading around 6:30 in the morning. I'm West Coast of the United States, and so the US market opens up at 6:30 for me. And so that's kind of when I start trading. I kind of, you know, trade for about 90 minutes. And so for me, I'm saying, okay, this market's at a support level down here, and I want to look to buy. And so then I go into a 1-minute chart, and if I actually pull up the recording of that now, so we can see what that's like in real time, so you can see what it's like entering in real time, not in hindsight, how the candles actually form. This is what it looked like on a 1-minute chart now, coming down to these levels. And so you can see again, it's just after 6:30. This blue box is my support zone, and up here I have a resistance zone that I also drew that we just kind of talked about on a 5-minute. And so from there, I have a couple steps that I take to look for the market to reverse. Now, the biggest thing is coming into these supply and demand levels is you don't know if the market is going to hold it or it's going to come down and it's going to just continue lower. And so that's the first thing that we need to do, is identifying when the market comes down to one of these levels. Is it going to bounce or is it going to keep going lower? And that's basically all I'm doing with this kind of step checklist that we're going through, is making it as likely to, when we get in, that it's likely that it's actually going to bounce off this level and you can take a profitable trade from that. And so the first thing of what that looks like is just thinking about the swings in the market. And so this goes back to our first way we identified trends, is a downtrend is signified by lower lows and lower highs. And so if the market's gonna just keep going down, it's gonna continue making lower lows and lower highs. And we don't wanna get in when it's doing that, because if you bought in right here, well, it's just gonna keep going lower. We need to make sure that that downtrend is broken. And so what we wanna be seeing is the market start to break that. And so we wanna see that there's these lower lows and lower highs have shifted into higher highs and higher lows of some sort. And the easiest way I do that most of the time is with a trend line. So right here you can see on my chart, I have kind of a rough trend line drawn. Again, going back to trend lines, they don't fit perfectly a lot of the time. They don't look super clean like we had in our drawings a lot of the time. Maybe you could draw from one from up here. You know, that's, again, the main thing is, okay, is it broken? And a big thing is you don't want the market to just break it a little and then keep going. It needs to be really clear that the trend line is broken. And so here, I think this is a pretty clear break of this trend line. Or if you had a trend line from up here, that's pretty clearly broken as well. You want to see multiple candlesticks broken out of it before you confirm that it's broken. So that's kind of the first big thing, is seeing either that if you can find a trend line, we do have a good trend line in this case, have that being broken, or, you know, you can just go back to the basics, lower lows and lower highs. Is that broken? You know, is it making a higher high and a higher low, and that, you know, pattern is broken? Or if you can't even identify those, you know, sometimes it's just looking for, okay, what is the velocity of the market? You know, is it just slowing down? Is it starting to go sideways? Is, you know, the candlesticks, are they just getting on top of each other a ton? Like, right, you can see here, the price is clearly starting to go sideways here. And so a perfect pattern that most of the time confirms that is that head and shoulders pattern that we talked about earlier. That's my favorite pattern because it just so easily confirms that bottom. It's showing, you know, the switch from the lower lows and the lower highs to making now higher lows and then higher highs potentially. And so the idea is, if you can get in somewhere here, when it bounces off of our demand zone, you can catch the swing back up into the future supply zone. And so this doesn't, of course, show up in every trade, but it is a bread and butter that you will see in a lot of my trades. And so from there, we want to actually narrow down into how we're going to enter into a trade. And so the last thing I want to see is kind of a candlestick reversal pattern happen where it shows you the market selling off, and then it triggers a massive reversal. And so right here, when that candlestick finish is forming right there, I usually like to jump in on that candlestick and then jump in. And I like to place my stop loss below this swing created from this candlestick pattern, or just the swing high that was made by the head and shoulders pattern. Just to show you another version of that, on the flip side, just to show you what that looks like with full candlesticks, here's a resistance zone or a supply zone. You can see the market's kind of coming up to that level. It's made an extreme high here, which we don't want to bet on. We don't want to short off of this and bet the market's going to go down just because it gets into our zone again. We want to wait for that confirmation. And the key is seeing the market start to reverse off of that level, and then it has this pullback here. And so when the market is right here, I'll wipe that candlestick out and pretend that we're looking at the market right here. The reason why I'm not betting that the market's going to go down yet is because I want that confirmation of that lower high happening. I want the market to show me that this is actually happening. You don't know when that's going to happen, and you don't know if it's going to happen. The market might instead decide to just continue higher right here, right? It could just continue in that uptrend and keep going higher. And so I want to see this lower high get in place. And so what does that is seeing this big bearish candlestick come into play and push the market lower. And I like to see it be a big bearish candlestick versus if it's just a small red candlestick, because what the big one shows is it shows momentum, and it shows that there's actually strength in the sellers, and it makes it more likely that the market is going to continue lower. And that's kind of the final confirmation that I want to get in on. And so as we go back to our example, I'll walk you through some of that. Now, this one doesn't have a picture perfect setup, and they won't always be like that. Of course, the market is different every time. And so that's why this takes time to get good at. And I'm going to walk you through everything I'm seeing so you can have a better understanding. And so the last thing I like to look for is what I like to call an exhaustive move. The idea that the market has used up all its energy. Think of it, you're like a runner and you're sprinting to the finish line here. And so you're running. And if this is the finish line right here, you're going to put everything you've got until you hit that finish line. And then as soon as you hit that finish line, you are exhausted and you're just going to crash in your energy level. And so that's what happens with trends sometimes, is that the market's in a downtrend. It's slowly going along. It's just kind of chugging with normal momentum. And then it kind of sees the finish line and it goes really extreme. It starts to go down really fast, and it has that exhaustive move where all of a sudden it runs out of energy and it collapses. And so it'll reverse very quickly. And so you can see that actually happening right here. is the market moved down really quickly here, and then all of a sudden it reverses very quickly. And so that's kind of the final confirmation I like to look for sometimes as well. And so you can see right here is it's a very large candlestick as well. And so for me, I like to get in based on when that happens. And so from there, I jumped in on a trade and I bet that the market was going to go higher. And so again, that was really fast. I will go through another example to help solidify some of these concepts because this is a lot at once. And then from there, what I do is you can see I put my stop loss down here. That's this red line. And then my thought process is if the market bounces there and it breaks this double bottom, and I'm probably wrong, and this support level down here or demand zone isn't going to hold. And that's okay, right? We can just get out based on that. And so from there, I just kind of let the market play out. And so I have a lot more fluid of management style, which we'll get into in a little bit later in the next example because I don't want to overdo it. But I pretty much just zooming forwards with this trade is, this is on a 1 minute chart, by the way. And so each one of these candlesticks is a minute. And so this trade went pretty fast. And so you can see here, once the market kind of got moving in my favor, I moved my stop loss to break even. And so I took some risk off the table to capture some of my profits. And then as the market starts to get up here, you can see we're at $1,800. And so that's 3 times my risk. And so, when I'm risking $600 a trade, and so you can see there, I closed out at 3 times my risk. It happened really fast actually. But right here, you can see as this candlestick closes right here, as it counts down, I move my stop loss and get out of the trade at that profit. And so that's what I did once, the market did that exact kind of thing that we were just talking about, that kind of exhaustive move on the flip side. Is it kind of had this move, a methodical move, and then it kind of saw the finish line, sprinted to the end, and then got overly exhausted. And over the next couple of candlesticks, it kind of crashes a little. And you can see based on my sizing, giving that kind of move back up would have been a lot of money. And so I find it better to just kind of get in quickly and then get out when the easy money is done. You don't need to try and capture the whole swing. The whole idea of this strategy is to get in when it makes sense and get out when it makes sense. You don't need to get in at the exact bottom and the exact top to make a ton of money. That's kind of a fairy tale. The whole idea is if you can capture kind of the majority of the swing, you're gonna make a ton of money in the long run if you can consistently do that. And so that's the whole goal of this strategy. And then from there, all I do is I just move on in the next trade or the next day. A lot of the time when I take a trade, I am done for the day because trading takes a lot out of you and it's good to move on and reset. What you want to do is you want to be as focused as possible and as energetic and refreshed as possible. And if you're not, you're going to make poor decisions. And poor decisions in trading lose you money, right? And so that's the whole idea of trading for a short amount of time and then moving on with your day and doing something else. And so let's go over another trade example. And so this one is another trade in oil futures actually. I don't always trade oil futures, but these have been really good examples on this chart. And so again, coming into trading, all I do every day is look at, okay, if the market's trading right here, where are the levels that I want to be aware of? And so down here, the market's bounced pretty clearly down here. And so I think there's a pretty good chance that, okay, if it comes down here, I want to be aware of that, but that's pretty far away, right? And so the next level is, well, the market's kind of come up here and chopped around here. It's made a couple moves here. And so I think this is a good level to look after as well. And then of course you have all the way up here as well. There's kind of a good level up there, but again, that's really far away. And so it's unlikely the market's gonna get there. The most likely thing at the moment is the market being at this level right here. And then you can actually see there's kind of an uptrend right here that the market's in as well. And so going down our trade entry checklist, the first thing is always seeing if we're at a support or resistance zone. We are right here. There's a clear resistance zone that we're at. And then the market started to bounce off of it. You can see it's made a peak here and it's coming down, and we're about to get in a trade right here. And so analyzing the trend coming up into this, you can see that there's an uptrend right here. It's kind of bounced off of it right here, here, and here. It broke it right here, and it's been a clear break. Multiple candlesticks have broken out of that. So that's kind of step 2 being done. And then step 3 or 4, I kind of interchange those sometimes. And so the next thing is looking for that head and shoulders pattern. So you can see here, market's kind of moving up, pretty tight trend, has a pullback, new high, and then has another pullback. And then right here, it's starting to make that lower high that I like to wait for confirmation off of. And so right here, you can see that it's making higher highs, and then it switches to now making a lower high. And so that's what we kind of want to be looking for, is seeing that head and shoulders form, because I like to get in kind of right here when that closes. And then the next thing on that checklist is looking for that methodical move. You can see the market was moving up pretty methodically here. Nothing crazy. The candlesticks were kind of just small, you know, back and forth, but still slowly moving up. And then we had a pretty big sell-off here, and then a massive bullish bar reversing higher. And then the market started to slow down again, and then it reversed and then went sideways and broke that trend line. I think if it held this trend line and kept going higher, that's totally fine. You know, the trend's still doing its thing, but because this kind of exhaustive move, that final sprint, is coupled with this trend line breaking and it's starting to make a new low here, this low right here is lower than this low, which helps confirm that the market is starting to lose steam, lose momentum. Again, just looking at the big picture, it's going up, now it's starting to go sideways. And what happens when it goes sideways? Well, it's going to make a decision of which way it's going to go. And the idea of all these factors, again, it goes lower from there. And so the final thing with that is looking for that kind of reversal candlestick or reversal pattern. And here, I thought this was good enough for me for this specific trade. Was the market bottomed here, had two big candlesticks that moved up. You can see this one right here, it kind of started to, it had a big wick here. So showing that, you know, if we look at these kind of two candlesticks, the market went up on that big green candlestick, reverse, closed out right here. And then this red candlestick right here, pretty much just opened here, went up a tiny bit and sold off hard, kind of closing at the lows there. And so from there, that, to me, that just shows it went up and it reversed. And the idea with that is coupling that with the head and shoulders pattern that we're looking at up here. That's what we're looking for. And so from there, I enter in on an order and I let the market fill me. And so sometimes I'll enter in on a limit order here or a stop market order. Again, a lot of that's kind of personal preference. Play around with that and see how you, whichever you like. And so just to be clear, this is me betting that the market's going to go lower. This is a short signal, as they would say. And there I put my stop loss, kind of like I always say, right above that swing, because my thought is, well, if the market's going to continue higher here, well, I'm wrong. You know, I'm not reading the market right, or, you know, the signal just doesn't work out. That's totally okay. You're going to lose trades, right? And so from there, I just let the market play out. And this is on a 5-minute chart. And so this takes a long time. You can see this is a timer right here. I've sped it up so it doesn't take forever. And a big thing I've realized over time is you have to just let the market sit there for a while. You have to just let it play out. You cannot come in and see the market kind of break down here, see that you're up, you know, $300, and then close out for a profit or go break even, because it's not about the money. It's about waiting for the bigger picture idea that you're looking for to play out. And the big picture idea that I'm looking to play out here is that, well, the market's come up to this level in a big picture way. And if we just look at the higher time frame again, you know, we're looking for the market to come up to this big picture level here and do a large reversal off of here. I'm not looking to capture a little tiny move here based on this big picture signal. I'm looking to capture a larger move. And so you can't let the excitement or the nervousness or just the greed, whatever it is, make you want to close out on a trade when it gets up a little bit, because that's not what we're trying to do here. We're trying to wait for that big picture to play out. And the market doesn't go right away really fast in your favor all the time. Now, the last trade, it kind of did that, and that's awesome when it happens, but that doesn't happen all the time. And you can see here, the market, this can be really scary too. The market comes up here and gets in the negative for a while. You know, it gets close to knocking me out at a loss. And what you have to do is you just have to let it play out. You just have to let it do its thing. It really looks like it's gonna knock me out right there. And even just watching this, even though I know what happens, it's making me nervous, because it sucks to lose. It sucks to be wrong in trading. But again, that's just a part of the game. You have to stick to it and let it play out and let the math do its thing. You don't know what the market's gonna do. You being scared and nervous of what the market's gonna do up here is you projecting on the market and not knowing what it's going to do and being scared and fearful of the money side of things when it's going against you. And in reality, this looks really good. The market's, if you think about it, big picture, the market's come up here and it started to slow down and it started to lose momentum now. It's starting to make lower lows and lower highs. And that's what we're looking for. You don't know what that's going to look like. It's, you know, when I'm drawing these pictures, you know, it looks nice when it just goes like this, but you don't know what that's going to look like when it actually happens in the market. It can look really crazy and all over the place. and take a while to happen. And I find that happens a lot of the time is I'll get in and the market takes a while to play out and you just have to sit there and let it do its thing. And you have to wait and deal with that. And so the way to do that is to have your plan that you're sticking to. And so my plan is that I'm waiting for it to get to a certain place. I'm waiting for it to move and look a certain way before I switch my strategy to, moving my stop loss to break even and then slowly moving my stop loss down with the trade. And so this is why having a trade strategy in play is really, really important. And so that's why you don't want to focus on the money. In my recordings, I have the dollar sign here to show people, but on my actual charts, it's hidden because you don't want to focus on the money. It's about focusing on the process and the patterns that you see, because again, over time, this dollar amount is going to get really large. Or when you first start out, it's a really small amount and it's frustrating because you want to be making more money than you are. And maybe you're only up $100 when a trade goes really well in your favor, and that's frustrating because you want more. And you see other people like me making a lot more money from the same moves. And again, you don't want to focus on that. You need to focus on the process and where you are in your own journey. And so you can see here, I'm drawing some things on the chart. I'm seeing there's a support zone down here. I'm seeing a tight downtrend. And so what just happened is I moved the trade to a 1 minute chart. And so the candlesticks, you can see, got a lot smaller and more. And the idea with that is that you can see now the market, it was moving around. We were just waiting in the trade before it started going. And then all of a sudden it started going in our favor really well. And so it's in a really, really tight downtrend without any pullbacks. And so that's awesome when you're in a trade because you don't have to deal with any pullbacks. But what happens is it's unhealthy. And so what that means is when there is a pullback, it can be really big before it keeps going down. And so what I do here, you can see, is I have this downtrend, and the idea here is I'm going to close out when it breaks this downtrend. And I like to kind of give it one candlestick worth because sometimes the market will break it by one candlestick and then reverse lower. So pretty much I'm looking for it to clearly break the downtrend that we have here and then get out of the trade, because the idea is that I don't want to, keep my trade up here at break even and let the market come all the way back against me, hoping that the market will continue lower. Generally, the idea of why people do that is it's because of greed. They're excited at the potential, wow, I'm already up this amount. It could keep going and I could be up, $3,000. And that's trading emotionally. You want to be focused on the math. Again, the math is I'm up about 3 times my risk down here. That is an awesome, super great trade. The math is great. I'm totally happy to get out of the trade at this point and close out for a profit. So that's what happens here is it closes out. And again, I move on to the next trade. And sometimes you're wrong. Sometimes I'll get out right here and the market will reverse and keep going lower. And if, I just stayed in a little bit longer, had my stop up here, I would have caught a massive 10x trade. And you can't think like that. Don't hindsight trade. It's going to eat you apart. There's always going to be things in the market that screw you over. And to show you a perfect example of that, here's a trade I took actually this month. And again, similar thing, right? I'm just following my strategy. You can see there's a resistance zone up here. The trend is clearly broken. It's going sideways. I've seen kind of an exhaustive move right here, and it's starting to make lower highs. You can see it's starting to go down and it's pretty choppy. And so I've got in on the market. I'm betting that it's going to go lower, and it's looking actually really good right here. It's kind of breaking out of this low uptrend I have right here. And so to just kind of zoom forwards, again, it's still looking really good. It comes back a little bit, just like that trade we just had, and it continues to lower. And so again, it looks really good. And again, though, what happens is you don't know what's going to happen in the market. Anything can happen in the market. And what happens is the market makes one more high here and then pukes lower from there. That can be extremely, extremely frustrating to happen, is, seeing that happen. I was just in a trade here. It barely came against me and now it's going lower. And so what I'm going to do now is I'm going to increase my stop so that doesn't happen to me again. And you can't think like that because anything in the market is possible, and the worst scenario for your strategy is going to happen at some point. If you think about it in terms of statistics, like a bell curve, is you have the majority of your trades are in this area of the bell curve. And you have some trades like this trade right here, this loss right here is kind of in the 1% chance to happen. It's super unlikely. And if I try and incorporate my strategy into trying to capture those trades that happen very rarely, I'm going to actually hinder my ability to capture these trades more often and be more consistently profitable and maximize the profit from those trades. Your whole goal should be maximizing your profits from the trades that happen more often. And so that's what you want to be doing. And so that's what I just want to say is, don't try and change things based on a couple of, trades that they suck. It sucks when they happen, but it doesn't matter in the long run. Again, it's about hitting the main portion of the trades that show up in your strategy. And so that's the really hard part about trading. You could give 10 people an insanely profitable strategy and they could all fail, because at the end of the day, it's about your ability to consistently execute that strategy and deal with the mental hurdles that come with that strategy. Now, if you want to accelerate your trading growth curve even more, I have a 90-day program that will teach you in 3 months what it has taken me 3 years to learn trading this strategy, and what I have learned from meeting with a trading psychology coach for the last 3 years, and what I've learned and how I've incorporated that into my trading to become successful as a trader. This video has actually been a sneak peek into what that program likes. Some of this will be in there. And what it has done is it has taken you from super basic to getting you kind of up to speed, intermediate trader, and kind of understanding the big picture of my strategy. That program goes way more in depth into the strategy and way more in depth than I do on YouTube. On YouTube, I kind of give a really good overview of my strategy, but in that program, it'll walk you through everything that you need to know about the strategy. A big thing that people run into is when not to get into the strategy and the trades, because it's easy to find the spots and it's hard to actually get into the right ones, and they end up taking more losses than they should. And then as well, it builds you a framework and a foundation to become a consistent profitable trader. It helps you build the mindset of a profitable trader, which again is really what makes or breaks traders. I think honestly, trading is 100% mental. Strategy is such a small part of it, because it's really easy to spot patterns. Sure, it takes a little bit of time, but the mental game is really what separates the losing traders from the profitable traders. Now, if you want to see more trades and walkthroughs before you commit to that, by all means, check out this video right here. I go way more in depth into multiple trades and how I execute my strategy consistently, and I know you will find it extremely beneficial.